Good morning, dear students. Very good morning, everyone. I just welcome you all to this session of revision for CA Final Advanced Financial Management. We have covered the topics of advanced capital budgeting, then portfolio management, and also security valuation, and the mutual fund topic was ongoing. So we have done, I think, couple of case scenarios on mutual funds. Let us do approximately 2 or 3 more case scenarios, and then we'll take up the next topic, which is the business valuation. Okay, so the next case scenario for the mutual funds category, we are going to take it up this as, just wait a moment. Yeah, this one, case scenario number, I think, yeah, this is 26th is done now. 27, 28. Thirty-eighth, I think, it says to be 10. This one, dividend, yeah, 38 was the last thing that we did. Now we have to do the next one, which is question number 39, or the case scenario number 39. Okay, so let's go for 39th case scenario, guys. Mutual funds. I think this is one, and one more is there, and then after that we can start with the business valuation. So asset management company of the mutual fund has declared a dividend of 9.98% on units under the dividend reinvestment plan for the year ended 31st March 2021. Investors are issued additional units for the dividend at a rate of closing NAV for the year as per the conditions of the scheme. So we're saying that it has declared a dividend of 9.98% on the units under the dividend reinvestment plan for the year ended 31st March 2021. So mutual fund has paid out this percentage as a dividend. Now investors are issued additional units for the dividend. So dividend is not paid in cash, rather dividend is paid out in the form of units. So the investors are issued additional units for the dividend at the rate of closing NAV for the year as per the conditions of the scheme. So the closing NAV was 24.95 as on 31st March. An investor, Mr. X, who is having 20,800 units at the year end, has made an investment in the units before the declaration of the dividend at the rate of opening NAV plus an entry load of 0.04. NAV has appreciated assume the face value of the unit as 10, then we have to answer the following. Okay. So closing NAV is 24.95 as on 31st March. An investor has made an investment at the year end at this NAV before the declaration of dividend at the rate of opening NAV plus entry load of 0.04. Okay. So now the question asks us the opening NAV of the asset management company shall be. Then the number of units purchased shall be original amount of investment, and which of the following statements is correct or incorrect. Okay. So how do we get the opening NAV? Because the question says that the closing NAV was 24.95 and Mr. X has made at the year end, as it has made purchase this much of units at the year end before the declaration of dividend, and the price is like opening NAV plus an entry load, and NAV has appreciated 25% during the year. So if NAV has appreciated 25% during the year, you can definitely say that your opening NAV is X. Opening NAV is X, and X into 1.25 because it has appreciated by 25%, right? So X into 1.25 will be equal to your closing NAV, which is 24.95. So this is equal to 24.95. So it's the solve this. If we just solve this, what's the value of X that we have? 24.95 divided by 1.25. So 24.95 divided by 1.25. That's 19.96. So option B. Number of units that this guy is going to purchase. The number of units purchased shall be. So Mr. X is having 20,800 units at the year end, right? And this, since the number of units are at the year end, we need to know how many units have you purchased. Now, Mr. X, who is having 20,800 at the year end, has made an investment units before declaration of dividend at the rate of opening NAV plus entry load of 0.04. So opening NAV is 19.96 plus an entry load of 0.04, which is 20. This is the price, this is the NAV at which you are purchasing the units. Okay. So this is the opening price, and we have been declared a dividend of 9.98%. Right. So dividend of 9.98% was declared. So we can say 20,800. Okay, 20,800 is a closing number of units minus 9.98% or minus 10 into face value being 9.98%. Rather, I'll say something like this, that let's say your opening units is X, and to that you're going to add 10 into 9.98% into X divided by the closing NAV, which is 24.95. So this total is equal to 20,800 because this is the number of units that you purchase. This is the number of units that you received as dividend. So total is 20,800. So this is X plus 10 into 9.98% into X, right? Because this is the amount of dividend that we are looking at. And then you divide it by 24.95. Okay. So what is the number of units that we have purchased in the beginning? Because the equation is simple. you take the opening number of units, which is X, plus you add the dividend, which is reinvested, 10 into 9.98% into X, and then divided by the closing NAV, which was 24.95. That's equal to 20,800. So this is going to be 10 into 9.98% divided by 24.95. Okay, 0.04. So this is 1.04x. So how much is this going to be? 20,800 divided by 1.04, which is 20,000 units, guys. So we have purchased like 20,000 units, the original amount of investment. Now this 20,000 units will be multiplied by the opening purchase price, which is 20. So that's 4 lakhs. That's option A. Then which of the following statement about expense ratio is or are inaccurate? Expense ratio. 4 statements have been given. We have to identify the inaccurate statement out of them. So it's the percentage of income that is spent to run a mutual fund. It includes advisory fees, travel costs, registrar fees, custodian fees, etc. It includes brokerage costs for trading of portfolio. So it is a percentage of income that is spent to run a mutual fund. First thing. Then it includes advisory fees, travel costs. Percentage of income. Is it a percentage of income that is spent to run a mutual fund? Or when you say expense ratio, is it a percentage of income? No, it's actually a percentage of NAV. So obviously this one is incorrect one. It includes advisory fees, travel costs, registrar fees, custodian fees. Yeah, this seems to be correct. It includes brokerage costs for trading of portfolio. Yeah, this is also correct. Then high expense ratio can seriously undermine the performance of mutual fund scheme. This is also correct. So the only thing which is incorrect is option 1. So therefore option D is correct one. Dash ratio considers the downside deviation instead of total standard deviation in the denominator. So which of this is going to tell you the downside deviation? That's your trainer ratio. Sorry. That's your Sortino ratio. Because Sharp and trainer, you're taking the overall risk. Sharp takes into account the standard deviation and trainer takes into account the beta. Okay. That's about this particular case scenario, guys. So let's take up next case scenario. We have it or else. No, I think this is done. Yeah. We're done with the mutual funds part. Now let us take up the next topic to be discussed, which is the business valuation. Okay. So business valuation is just a further extension of security valuation, in which we are not looking to value a single security. Rather, we are looking to value, not a single security, but we are looking to value the business as a whole. Okay. So value 0 will be cash flow 1 upon K minus G, which is simply like, a simple method of taking the present value of all future cash flows. And this is like, this formula is applicable if we have the cash flows are growing at a constant rate. So if the cash flows are growing at a constant rate, then we use the formula of C1, the CF1 upon K minus G. And this is similar to the Gordon's dividend model that we have. Okay, so if you are intending to hold a security for an indefinite period, so if you're intending to hold the security for an indefinite period, then we have the value of security as CF1 upon K minus G. If cash flows are growing at a constant rate, then V0 is going to be CF1 upon K minus G. Then we have like 5 years. Suppose, for example, if we have 5 years and, the problem, as I said, with this is K minus G. So cash flow 1 is K minus G being the denominator. The problem over here is, guys, if the growth rate is going to be, more than K, the growth rate is more than K, then the value is definitely going to be coming out to be negative, which is quite absurd. Right? So we don't want that absurdity. So we just thought, how can we really solve this problem? The problem is that the K minus G may become negative because K is lower than G. So the growth rate, we are going to break it into 2 parts, and then we are going to call it as a 2-period growth rate, 2-period dividend discount model, 2-stage dividend discount model, which is quite obvious that a high growth rate cannot be maintained by a company forever. It's going to be there for initial few years, and then later on it's going to settle to a lower rate. So growth rate is 10% for 4 years and 5% from year 5 onwards. So growth rate is going to be, let's say, 10% for 4 years, 5% from year 5 onwards. Okay. So for initial 4 years, we calculate the cash flows by using the same 10% growth rate. And then for the 5th year, we are going to grow the dividends by 5%. So value in year 4, or I can say terminal value, needs to be computed first. So terminal value will be cash flow in year 5 divided by K minus G. Now remember, this is the value of the company in year 4. And then when we bring it to the current value, we say that the value of the company today will be present value of cash flows or the dividends from year 1 to 4, and then take the present value of the terminal value also. Okay. So that's one of the approach. Then apart from this, we can also have multiple different approaches to value the business. One is taking the net asset value, which is nothing but the book value of the business. So book value will be like, take out the balance sheet, and from that you just identify what's the total number of fixed asset, total current assets, subtract the current liabilities and the long-term debt. Net realizable value, it is actually the realizable value of assets minus the realizable value of the liabilities. So that's your net realizable value. So realizable value of assets minus realizable value of liabilities. The replaceable value is, or replacement value will be like, what will be the cost of the entire group of assets and liabilities of equivalent company in the open market. So you just try to find out in the open market, what would be the value of the company. So that's your replaceable value or replacement value, you can say. So this is like asset-based approach. Apart from this, we can carry out the valuation by looking at an income approach also, which could be a relative based approach. So for the income approach, we look at the PE ratio. So the PE ratio is EPS equal to 12. Let's say PE ratio is what? Price to earning. So EPS is 12 and price to earnings is 14. So the price is going to be 12 into 14. which is 168. Right? So you look at EPS, you look at the ongoing PE ratio, price is 168. Capitalization of earnings, this is annual uh, future maintainable profits divided by the required return. So that's your capitalization of earnings method, where you divide the future maintainable profits by the required return. This is again like assuming that future maintainable profit will be attained till perpetuity. Cash flow based approach is the one where we calculate the free cash flow. Now, how do we get the free cash flow? We start with PAT, then we subtract any one-time income that we are receiving, add any sort of one-time expense, add back the depreciation. Right? So that's your free cash flow. Now, out of this free cash flow, you're going to subtract the two investments that you're going to make. One is into the working capital, and another is into the capital or into the fixed asset. So you subtract both the investments, and then you get the adjusted free cash flow. Right? And this adjusted free cash flow will be multiplied by PV factor to get the PV, and then you just take the total of all the PVs and also add the present value of the terminal value. So these are the approaches that we use to carry out the valuation of business. Okay. Then one important concept is understanding the beta of equity and beta of asset. So beta of equity is beta of asset into debt plus equity divided by equity. This is a scenario where we say there is no tax applicable. So value of beta of equity is definitely going to be higher than the value of beta of asset, because equity shareholders tend to be undertaking a greater amount of risk as compared to assets, right? As compared to the debt, because the amount of equity investment is lower and debt as compared to the total asset. And we can say the total asset risk is borne by few equity investors. Total asset risk is borne by few equity investors, and therefore per unit of their equity investment is going to be quite higher. Now, why do we need to understand this beta of equity and beta of asset? Because we have to, let's say, value an unlisted company. Now, to value an unlisted company, we need its return on equity or cost of equity, which will be RF plus beta into RM minus RF, right? And now we don't know what is the beta of that unlisted company, because since it's an unlisted company, you won't know what is the beta. So for that, we'll have to first compute the equity beta of the listed company, right? From that, we will calculate the asset beta of the listed company, which can be taken as a quite easy replica of the unlisted company or a proxy beta. And then you convert it to our company equity beta by using the debt equity ratio of our company. So in this way, we'll be able to get the equity beta of our unlisted company. So once we get the unlisted company value in unlisted company beta, then we can obviously calculate the cost of equity, and then we can take it further for calculating the value of what we call as the value of the shares by carrying out the cost of equity, and also discounting the future cash flow, right? So that is the all concept that we have in business valuation, which is similar to what we have done in the security valuation. Now, let's just take up the case scenarios on business valuation that we have. Okay. So Okay, look at this case scenario number 12, guys. Look at this case scenario number 12. Just try to read it and answer it. Answer the questions. Give it a try. Case scenario 12. Okay, let's turn the discussion base. So here we have during one business meeting at ABC Limited, one of the members presented data related to three companies, X, Y, and Z, whose operating income are equal. So all three companies are having the same level of EBIT. The invested capital is also same, but debt to assets ratio, number of shares outstanding, cost of debt and cost of equity is differing. Now, tax rate is uniformly applicable to all three companies at the rate of 35%. The industry P ratio is 10x. From the information given above, choose the correct answer to the following questions. Now, first, we want to calculate the weighted average cost of capital of Y Limited. Now, weighted average cost of capital of Y Limited. How is it going to be the weighted average cost of capital? We have the debt to asset ratio as 0.5. Cost of debt is 8.45. So weighted average will be 0.5 into 8.45 plus 0.5 into 22. So 0.5 into 8.45 plus 0.5 into 22. Okay. So this is coming out to be 0.5 into 8.45, which is 4.225 plus 11. So 4.225 plus 11, that will be 15.225. Okay, so that's 15.225. And the correct option is B, 15.23. Then economic value added. Yeah, this was something I think we didn't revise. Economic value added. Where is it? So, economic value added is simply the operating profit which the company has earned over and above the expected return from the company. So, economic value added is net operating profit after tax minus weighted average cost of capital into invested capital. So, NOPAT is obtained as EBIT into 1 minus T. So, let's simply apply that. So, we need to get for X Limited, first the NOPAT. NOPAT is EBIT into 1 minus T. EBIT is 10 lakh into 1 minus tax rate is 0.35. Okay, which is 6 lakh 50,000. Net operating profit after tax is 6 lakh 50,000. Subtracting from NOPAT, we are going to subtract net operating profit after tax 6 lakh 50,000 minus the weighted average cost of capital into the invested capital. So weighted average cost of capital needs to be computed for X. So for X, the weighted average cost of capital will be 10.4 into 0.8 plus 26 into 0.2. And this thing is multiplied by, so into 40 lakhs. So what is this number going to be? 10.4 into 0.8 plus 26 into 0.2. That's 13.52. 13.52% of 40 lakhs. That's 5,40,800 5,40,800 minus 6,50,000. So that's 1,09,200 is the economic value added. Okay. Then the price per share of Z Limited. So now for price per share of Z Limited, I need to get the EPS. So EPS can be computed as what? 10 lakh is the EBIT minus interest is going to be interest will be on the invested capital 40 lakh into debt is 0.2 into 40 lakh into debt to asset ratio of 0.2. 40 lakh into 0.2, which is 20%. On that, we have the interest rate as 9.75% divided by 1 minus 0.35. So that's 40 lakhs. 40 lakh into 0.2 is the amount of debt into 9.75%. And then this divided by 0.65. 1,20,000. So 1,20,000 minus 10 lakh, which is 8,80,000. And then that 8,80,000 will be divided by the number of shares that we have, which is 2 lakh. This is the EPS, and then this EPS is going to be multiplied by the P ratio of 10. So price comes out to be 44. I think there's a mistake. I think we're done. Sweet. So 40 lakh into 0.2, that's the amount of debt, into 9.75% divided by 0.65, which is 1,20,000 minus 10 lakh, which is 8,80,000. So this 8,80,000 will be multiplied by, to make it post-tax, will be multiplied by 0.65, which is 5,72,000. And this you're going to divide it by the number of shares, which is 2 lakh. 2.86 into the P ratio of 10. So 28.6 is the answer. Market capitalization of Y Limited. Now, market capitalization of Y Limited. For that, I need to get the EPS and then I will just multiply it with the P ratio. Right? So, Y Limited P ratio. So, we have a EBIT of 10 lakh. From that, we subtract the interest. So 10 lakh being the EBIT. From that, we are going to subtract the interest. So interest will be 20 lakhs into, because half of that is funded by debt. The 20 lakhs into 8.45% by 1 minus 0.35. 20 lakh into 8.45% divided by 0.65, which is 2,60,000. So 2,60,000 minus 10 lakh, which is 7,40,000. So 10 lakh minus 2,60,000, which is 7,40,000. And on that, you're going to multiply 35% tax rate. So into 0.3, or let me make it as into 0.65. 4 lakh 81,000 divided by number of shares is 1,66,000. So 4,81,000 divided by 1,66,000. Then you multiply it with the P ratio, which is 10. So what 4,81,000 divided by 1,66,000. So this is what 2.8975. EPS is 2.8975. MPS will be into 10, which is 28.98. And then the 28.98 will be multiplied by 1,66,000. So 28.98 multiplied by 1,66,000 being the number of shares, which is what 48,10,000. Yes. So option B, 48,10,000 is the market capitalization of Y Limited. Earnings per share of X Limited can be computed by starting with EBIT of what 10 lakh. From that, we are going to subtract 40 lakh into 80%. 40 lakh into 80% into 10 lakh minus 40 lakh into 80% into post-tax cost of debt is what? 10.4% divided by 1 minus 0.35. 40 lakh into 0.8 into 10.4% divided by 0.65. 5,12,000 minus 10 lakh, which is 4,88,000. And that 4,88,000 will be divided by 1,22,000, which is earnings per share coming out to be 1 second, I think 4 lakh 40 lakh into 0.8 into 10.4% divided by 0.65, which is 5,12,000 minus 10 lakh, which is 4,88,000. Okay. So 4,88,000 will be multiplied by 0.65 to make it after tax. And then you divide this by the number of shares outstanding of X, which is 1,22,000, which is 2.6. Yes. Fifth option A, 2.6. So quite a elaborate, or you can say extensive case study where we have to calculate at each point of time certain numbers. Now, let us take up the next case on business valuation. So I have this case scenario number 30 now. Okay, try out this case scenario number 30. Okay, let us begin. So again, this is similar to the previous one, just the numbers are different, but calculations are going to be similar. So during one business meeting at XYZ, one of the members pointed out that while evaluating the performance of any company, one should not only looking at operating income, but also analyze the capital structure. So we have like three companies with their capital structure, pre-tax cost of debt, cost of equity, everything given. So first we need to get the weighted average cost of capital of Alpha Limited. So weighted average cost of capital Alpha Limited will be cost of equity is 26% into weightage of equity is 0.2 because debt to asset ratio is 0.8. To that we add 16% into 0.8. So this works out to be how much? 26 into 0.2, which is 13, and 16 into 0.8, which is 12.8. So 13 plus 12.8. 16% into 0.8 and 26% into 0.2, sorry. So that will be 26% into 0.2. That's 5.2 plus 16 into 0.8, which is 12.8. So 5.2 plus 12.8 is 18. So option D is accurate. Economic value added of Beta Limited is, so economic value added of Beta Limited is going to be, so we have the EVA. EVA for Beta can be computed. First, we need to get the EBIT into 1 minus T, which is no PAT. So that's 5 lakh into 1 minus tax rate, which is 35%. So into 1 minus 0.35, your tax rate. Okay, so 5 lakh into 1 minus 0.35 minus, that's EBIT into 1 minus T, minus the weighted average cost of capital. So total invested capital is what, 20 lakh. That is going to be multiplied by the weighted average cost. Well, the weighted average cost will be 22% plus 13% by 2 because weightage is anyways equal. So 5 lakh into 0.65. 3,25,000 minus 22 plus 13, which is 35 by 2, 17.5%. So that's minus 0.35. 5 lakh into 0.65, which is 3,25,000. And then we have the invested capital is 20, on which the weighted average cost of capital, since the debt to asset ratio is 0.5, so that's going to be 22 plus 1335 divided by 2, which is 17.5%. So on 20 lakh, you have 17.5%, which is 3,50,000. So minus 3,50,000. So economic value added is coming out to be negative 25,000. So we're not getting this over here. So okay, so it is 13%. Okay, so this is pre-tax cost of debt, guys. So since this is pre-tax cost of debt, I need to adjust this for I think the first answer is also now the challengeable, because here the tax which was 16%, it's not, this needs to multiply by 0.65, guys. So I think, yeah, the first answer is also going to change. So this is pre-tax, so we need to make it post-tax by multiplying it with 1 minus t. So 16 into 0.8 into 0.65, that's 8.32 plus 5.2, which is 13.52. Yeah. So correct answer for first one will be A. And then for second one, we'll do the calculation by doing net operating profit after tax. So for beta, is 20 lakhs. I need to 22% into half plus 13% into 0.65 into half. So 22 into half, which is 11. So plus 11, 15.225 into 3,04,500 0.35. So 3,04,500. Then it's fit, which is with the P ratio into 20%. So let's first calculate this number. 15% into 15%, which is 4 lakh for minus 60,000, which is 4 lakh tax rate post tax 1 lakh 46 option C. Estimated margin alpha, we can say the market cap is going to be computed as, first we need to get the 5 lakh divided by 65%. Okay, and that's going to be this divided by the number of shares is 61,000. So let's try to get 20 lakh so 20 lakh into 80% into 16%. So 20 lakh into 80%, that's 16 lakh. On that you have 16%, 2,56,000 minus 5 lakh, which is 2,44,000 into 65%, which is 1,58,600 divided by 61,000. So 2.6 is the EPS. 2.6 multiplied by the P ratio of 11, which is 28.6, and that multiplied by the number of shares. The number of shares of alpha is what? 5 lakh. So 28.6 market cap is going to be 28.6 into 500, which is 14,250, or no, it is something different. So what we did is the EBIT minus total invested capital into 80%, which is the amount of debt. On that, you're paying an interest of 16% pre-tax. So if there's some issue or what, I think, 1 second, 5 lakh, you can say this is 5 lakh minus 20 lakh into 80% into 16%. This comes out to be 2,44,000. Then this multiplied by 65%, that's 1,58,600 divided by 61,000, which is 2.6. So 2.6 into 11, 28.6. Then this into 61,000. Yeah, so it is 17,44,600. Yeah, option C, 17,44,600. That's the estimated market cap. Then earnings per share of Beta Limited. So you want to see what is the EPS of Beta Limited. So earnings per share of Beta Limited can be calculated as EBIT of 5 lakh minus interest will be on invested capital of 20 lakh into 50% into 13%. 20 lakh into 50% into 13%. So that's 1,30,000. So 5 lakh minus 1,30,000, which is 3,70,000. Earnings per share of Beta Limited is approximately. So this into 0.65. So 3,70,000 into 0.65, which is 2,40,000. This divided by number of shares, which is 83,000. So 3,70,000 into 0.65 divided by 83,000. That's 2.90 or 2.89. Okay. That's case scenario number 30. Let's take up another one. Okay. Let's try to solve this case scenario number 44 now, guys. Try out this case scenario number 44. Okay, guys. So let us look at this case scenario 44. So following financial data are available for PQR Limited for the financial year ending 2023. 8% debentures at 125, 10% debentures of 50, equity share, reserves and surplus, total assets, total asset turnover, effective interest rate, margins, and everything is given. Now the question is 10% bonds must have been issued in the month. Okay. So operating margin is 10%, and we say that total assets is 600 and asset turnover is 1.1. So sales will be 600 into 1.1, which is 660. Okay, and then we have the EBIT or the operating profit margin as 660 into operating margin is 10%. So 66 is your EBIT. Okay, and then the question says that operating margin is so and so, effective interest rate is 8%. Dividend payout is 16.67%. Now we have this 10% bonds. 10% bond, which is issued in 2022 of 50. So EBIT is 66. Then we have the market price of share, dividend payout ratio is given. You have to get the time period in which the bond was issued, or the month in which the bond was issued. So how do we get that? So we have this current market price of share and the required return for investors. So from that EBIT, I need to subtract this interest. Now the effective interest rate, they're saying it is 8%. Effective interest rate is 8%. So 8% bond and 10%, 8% debenture and 10% bonds we have. So since the effective interest rate is 8%, I can say interest is 125 plus 50 into 8%. So that comes out to be 125 plus 50, which is 175 into 8%. That's 14 being the interest. Now remember, this 14 will be equal to 125 into 8% because this was there for full year. And then this is 50 into 10% into we don't know the number of months. So I can compute this number of months. That's 125 into 8%, which is 10. And then 50 into 10%, which is 5, is 10 plus 5x by 12 is 14. So 50 into 10% by 12. Okay, so we have this as 4 equal to 5x by 12. So x will be 4 into 12 by 5. 9.6 months. So if that's 9.6 months, so bond is outstanding for 9.6 months. So basically, it will be in the month of June, right? Because April and May, 2 months gone, and half of it. So it will be June 2022, option B. The amount of retained earnings for the financial year 2023 approximately is. So retained earnings. So for that, we have the EBIT number. EBIT of 66. From that, we are going to subtract the interest of 14. So we have the PBT as 52. From that, you pay out the tax as 40%. So 52 into 40%, which is 20.8. Then we have 52 minus 20.8, which is 31.2. So EBIT minus interest is PBT. And from PBT, you subtract the tax, that 31.2. 31.2 is the profit, and dividend payout is 16.67%. So less dividend payout. So that's 31.2 into 16.67%, which is 5.2. So the retained earnings is going to be 26. So option C. Return on equity of PQR. So now return on equity of PQR will be 31.2 is the profit after tax upon 400. 31.2 divided by 400. That's 7.8% D. Sustainable growth rate. Sustainable growth rate is, it is B into R. So B is the retention ratio. Retention ratio is what? 83.33% into R is return on investor is 15%. $83.33 into 15%. That's 15%. And then we say that's 12.1 second. No, it's not. It won't be 15%. Since we want that, so the return on investment is what? EBIT is 66 on an investment of 600. 66 on an investment of 600. So 11% of 83.33. After tax figure. After tax return on equity, I need to get. Return on equity is 7.8%. Okay, so I need to multiply it by 7.8. So 83.33 into 7.8. That's 6.5%. Yes. Fair price using the dividend discount model. So for that, I need to get the dividend. Dividend is 5.2 upon K is 15% minus growth rate is 6.5%. So 0.15 minus 0.065. 0.15 minus 0.065, which is 0.085. So 5.2 divided by 0.085, which is 6.12. Option C is the accurate answer for the fair price. Okay. So that is about this case scenario 44. Then F5. Okay. After this, let's take a break. And once you come back from the break, try out this case scenario number 55 is. So we'll take a break of around 15 minutes. And then after that, we are going to start with case 55 discussion and maybe some questions from the NTP also after the break. Okay, let's take a break now, guys. of 5 rupees for the current year. Next year, it's going to be like 25%. It's going to grow for 6%. And then after that, 10% per annum. So the return of government bond is 13% per annum. Market return is expected to be around 20%. And then we have the correlation between market return and Z Limited share return is 0.3733. Standard deviation of market return and Z Limited shares is 12% and 18% respectively. So from the information given above, we have to choose the appropriate answer. What is the expected return of Z Limited shares? Now, expected return for that, we can say the return of government bond is 13% and market return is expected to be 20%. Correlation between market and that of the return is 0.377, and then we have the standard deviation. Now, to get the expected return, I need to get the beta. So beta is going to be calculated as correlation into standard deviation of security upon standard deviation of the market. So we have the correlation number to be 0.3733 into standard deviation of security is 18% and standard deviation of market is 12%. So that gives you the beta number. So beta is 0.3733 into 18 divided by 12. So this is what? 0.56. So beta is 0.56. Okay. So that's 18 divided by 12 into 0.56, which is 18 divided by 12, 1.5 into 0.56, which is 0.84. So 0.56, that's the beta. So if the beta is 0.56, we can get KE as the risk-free rate, which is 13% plus 0.56 into 20% minus 13%. So this will be 0.3733. Sorry, 20 minus 13 is 7 into 0.56 plus 13, which is 16.92% return. So K is 16.92%. Okay, intrinsic value of Z. To get the intrinsic value of Z, I have to calculate all the future dividends for the next 6 years. So we can have to write down like year and then dividend and then take the present value of all of them. So intrinsic value of Z, we can simply get by taking the present value. So it's 55 question 2. You can see the solution quickly. Yeah, the present value of all the future dividends, and also you need to calculate the terminal value. So that gives you the value to be 118.53. So intrinsic value is 150. Intrinsic value is 38 point. Present value of dividend 38 and this 118. So 38 plus 118, that's what? 150. 156 is the answer. If the market price is 315, of course, it's more than the intrinsic value. So we will say that this is overvalued. The current market price is overvalued. Okay, so that's it. I think all the case studies of business valuation are done. Now, let us, since we have got some amount of time, let us take some questions from the model test papers. Okay. So let's take some question from model test paper 101, page 101. Okay, try out this question number 4, guys. 4A. Try out this question number 4A, guys. 4A karo. Okay. So Eagle Limited reported a profit of 77 lakhs after 30% tax. So of course, from this we can say that our profit before tax will be 110. For the financial year 2011-12, analysis of accounts revealed that the income included extraordinary items of rupees 8 lakhs and an extraordinary loss of rupees 10 lakhs. So an analysis of the accounts revealed that income included extraordinary item of 8 lakhs and extraordinary loss of rupees 10 lakhs. So the existing operations, except for the extraordinary, are expected to continue in future. In addition, the results of a new product are also given. So we can say future maintainable profit will be 110 minus 8 lakhs of extraordinary income plus 10 of extraordinary loss. So 102 plus 10, which is 112. So future maintainable profit is 112. The existing operations, except for extraordinary items, are expected to continue in future. So 112 plus the new project launch. So then profit from the $112 plus sales of 70 minus 20 minus 12 minus 10. So this is going to give you a profit of 70 minus 20 minus 12 minus 10. So that's 28. So 140, 112, 112 plus 28. So that's 140 future maintainable profit. We have a capitalization rate as 14%. So value will be 140 divided by 14%, which is 1,000. So value of the business is 1,000. That's pretty simple. Then okay, try out this question 4A, guys. Try this question 4A. So this valuation of Ansel Limited has been done by investment analyst based on expected free cash flow of 54 lakhs for the following year. And an expected growth rate is at 9%. The analyst has estimated the value of Ansel Limited to be 1800 lakhs. However, he committed a mistake of using a book value of debt and equity. So this value of 1800 has been arrived by looking at a book value of equity and debt. Now it says that the book value weights employed by the analysts are not known, but you know that Hansel Limited has a cost of equity as 20% and post-tax cost of debt is 10%, and the value of equity is thrice its book value, whereas the market value of its debt is 9/10 of its book value. So what's the correct value of Hansel Limited? That's what this question is asking us. Now with this 54 lakhs and with a growth rate of 9%, the value comes out to be 1800 years. So first we need to get what is the rate at which this has been discounted. So let me just solve it in a proper way by taking it into a separate sheet. Valuation of Hansel Limited has been done by an investment analyst based on expected free cash flow of 54 lakhs. So with this free cash flow 54 lakhs, expected growth rate is 9%. Estimated value is 1800 lakhs. So value will be, of course, free cash flow of first year divided by KO minus G. So free cash flow is 54. We don't know what is the KO taken, but the growth rate is given to be 0.09 and the value is 1800. So first we need to solve this to get the value of KO. So this will be like 54 upon 1800 is equal to KO minus 0.09. Okay. 1 second, guys. Okay, so we can say this is 54 divided by 1800. That's 0.03 plus 0.09 is equal to KO. So we can say KO is 0.12. KO is 0.12 guys. Okay, so overall cost of capital is 0.12, or you can say KO is essentially 12%. Okay, so I've got the KO as 12%, but remember this KO is incorrect one, or this is, I can say, based on book value, but I need to get the KO for the market value, right? Now we don't know what is the value taken. Book value weights are not known, but I can definitely say that the cost of equity and cost of debt is individually given. So I need to first get the revised KO as per the market value. Okay, the revised KO as per the market value. So how do we get that revised KO as per market value? Now, we can say that this KO would have been K into weight of equity plus KD into weight of debt. Okay, so this is what is 12%. And in the question we have cost of equity is 20% and cost of debt is 10%. So I can simply say cost of equity is 20 into weight of equity plus cost of debt is 10 into, I can take it as 1 minus weight of equity as 12. So we have 20 into weight of equity plus 10 minus 10 into weight of equity is 12. So 20 minus 10 is 10 into weight of equity is 2. So weight of equity is like 2 upon 10, which is 0.2. And we can get the weight of debt to be 0.8. But these are the weights based on the book value. Market value based weight of equity will be 0.2 into, because they are saying that equity is thrice, value of equity is thrice in the market. So it's 0.82 into 3, which is 0.6. And then we have market value based weight of debt. That will be 0.8 into 0.9, because that is 10% lower. Okay, so this is value of debt is 9/10 of the book value. So this is 0.72. So total comes out to be 0. Or not, it's 1.32, 0.72 plus 6 plus 0.6, that's 0.32. Sorry, 1.32. So if that is 1.32, I can get the revised KO will be 0.6 out of 1.32, which is the cost of, the weightage of equity. So weightage of equity is 0.6 out of 1.32. Cost of equity is 20. To that, we are going to add 0.72 out of 1.32. This is the market value based weight of debt multiplied by 10. So we get this value as 0.6 into 20 divided by 1.32. 0.6 divided by 1.32 into 20, which is what, 0. I don't know, there's some calculator. 0.6 into 20 divided by 1.32. Yeah, that's 9.0909 plus 0.72 divided by 1.32 into 10, which is 5.4545. So if you add them, 9.0909 plus 5.4545, which is 14.54, 14.5454. That's your revised KO. Revised overall cost of capital, 14.5454. Okay, so revised KO is 14.5454. And of course, we can get the revised value of the firm then. So revised value of business, I can say. We'll use the same formula. Free cash flow for the first year upon KO minus G. So free cash flow is 54 upon KO is 0.1454 minus the growth rate of 0.09. Okay, so that's 54 divided by 0.1454 minus 0.09. So this will be 0.145454 minus 0.09. So that's 54 divided by 0.05545. So revised value of the business will be 54 divided by 0.055454. That is 973.78. So 973.78. That's the revised value of the business. So we have taken that, we've seen that if you're taking the book value, the value was comparatively higher at 1800 and substantially higher because the problem is that you have taken a book value. Now, under book value, your KO was 12%, which is changing substantially to 14.54%. Right? So, because since your equity is having a more weightage, the overall cost of capital is, is increasing, and that is resulting into a very significant fall in the value of the business. Okay, so that's the revised value which we get, and obviously we see that the value is reducing because of increase in the overall cost of capital, increase in the overall cost, and that is primarily driven by more weightage given to the cost of equity, guys. Okay, so I think yes, we are good with the topic of business valuation. We have completed like 4 case scenarios and 1 more additional question from the model test paper since we had the time. So I think with that we are completing this topic of business valuation as far as the revision is concerned. So we have revised the concept and also done a few case scenarios so that the entire chapter is taken care of. So with that, I would like to call it a day. Thank you for giving your patient listening, guys. All the best for your exams. So I'll just share our contact details so that you are.
Thank you, Jagbandhu sir. Thank you. Thanks a lot. Now, student, with this, we have come to the end of our live revisionary classes sessions. Okay, in these sessions, we have covered every topic. We have not left any topic. So it is one of the part of your journey for your study for the May 2026 examination. Now, student, since it was a one part, another part is that now we are starting with the BOS for the success, okay, and fortnight program as well. So my request to you, please do also attend the same programs as well. And also, we are coming out with the series of mock tests. So my request to you, please, you also attempt the mock test in an examination like condition and assess yourself. Because by this method, you will able to understand where I stand. It is very important that for you to understand that where I stand, because unless and until you will understand that where I stand, it will be a bit difficult for you to uh, assess yourself, because in the main examination then certainly you will face the problem, because there is a time management, accuracy are very important factors are there. So of course we our email address and our telephone number is there. Of course all the queries have been taken up in the class as well. Still you have any query, you are free to ask us. And Jagbandhu sir, thank you very much for your sparing your precious time and letting the student on many topics. And your classes were very interactive, and student has very interactive in this class, and they have also taken a very keen interest in the sessions. So thank you very much, sir, once again, and we hope we shall meet you again on the same
Yes.
platform. Thank you, sir. Okay, student, thank you very much, and all the best for your examination. Thank you.